September 16, 1992. Panic is setting in. Inside the Bank of England, officials are making frantic phone calls to the government, realizing their control of the financial system is slipping away. They're requesting permission for a drastic defense to stop their currency from collapsing. Doubling interest rates in a single day backed the pressure of a single private citizen trading from the other side of on that conviction. By sunset, the Bank of England would face total public humiliation. Soros would walk away with over $1 billion in profit, proving that a lone investor could outmuscle a sovereign nation. To understand how one man broke a central bank, we have to look back to 1990. Britain had joined the Exchange Rate Mechanism, or ERM, a system designed to link European currencies as a first step toward a unified economy. The ERM forced the British pound to stay within a fixed, narrow price range against Europe's anchor currency, the German mark. But a structural flaw pulled the system apart. Germany fought inflation, keeping interest rates high. Britain, mired in recession, was desperate for low rates. The ERM chain held them together even as their economies moved in conflicting directions. This artificial peg created a fault line, forcing the pound to trade at a price that its real-world economy could no longer support. Soros spotted this vulnerability through the lens of his own past. As a Jewish teenager, he had survived the Nazi occupation of Hungary before fleeing communist rule to find work in London and New York. Surviving these regimes taught him that official government narratives and entrenched systems are often fragile illusions, prone to sudden failure. While most economists viewed markets as rational machines, Soros used a theory he called reflexivity, the idea that investor psychology can distort reality, pushing prices away from equilibrium rather than toward it. Applying this to the ERM, Soros saw that the pound's value was held up only by the market's belief that the UK government would never allow it to fall. Soros realized that Britain's financial armor was built on market psychology. If he could just hit the system hard enough to shatter that confidence, the entire fragile arrangement would collapse. Soros launched his strike by short-selling the pound on a massive scale, intentionally draining the Bank of England's foreign reserves. His multi-billion-dollar bet was too big to ignore. It triggered a wave of panic, causing other investors to dump their pounds in a self-feeding cycle that gained speed by the minute. The UK government burned through billions in taxpayer funds to buy back those pounds, but they were powerless against an overwhelming tide of market pressure. On the evening of Black Wednesday, the British government surrendered. They withdrew the pound from the ERM, effectively letting the currency crash. The control of a central bank had collided with the reality of market psychology. George Soros emerged with $1 billion profit and a reputation as the man who broke the Bank of England. In 1992, a single private investor decided to challenge the financial policy of an entire sovereign nation, betting that its government could no longer maintain its promised exchange rates. George Soros assembled a $10 billion short position against the British pound, a wager that the currency's value was destined to fall. Opposing him was the Bank of England, backed by the combined financial authority and cash reserves of the British government. The ensuing clash tested whether a nation-state's domestic economic decrees could survive a direct, overwhelming assault by a massive, highly motivated market participant. The buildup began in the summer of 1992. Soros's quantum fund started borrowing and selling pounds, establishing an initial $1.5 billion bet that he could buy them back later at a lower price. The British government publicly vowed to maintain the pound's value at any cost, promising to use its foreign currency reserves to buy back pounds and keep the price at its pegged level. This is a diagram of the government's foreign currency reserves. Soros's thesis was that the UK was defending an overvalued asset using strictly finite capital. Against those reserves stands the global market, which can keep selling as long as traders believe the government is outmatched. When the market realizes a government's resources are no longer sufficient to support an artificial price, the defense becomes a war of attrition that the state cannot win. The tipping point arrived on the evening of September 15, 1992. Helmut Schlesinger, the president of Germany's central bank, made a carefully hedged remark to a journalist, suggesting that one or two European currencies might still face pressure. He did not name the pound, but the message to trading desks was clear. Germany, Europe's strongest economy, no longer believed the British pound could hold its value. In high-stakes finance, an implicit lack of confidence from a critical ally is treated as proof of a target's vulnerability. By the next morning, trading desks in London and New York had reached the same conclusion about the pound's future. Soros moved immediately, refusing to wait for further confirmation before escalating his position. This visualization tracks the trade as it expanded. In a matter of hours, Soros increased his short position from $1.5 billion to $10 billion, borrowing from almost any counterparty willing to deal. Other prominent global traders followed the momentum, piling into the same short trade right behind him. The goal was to strike with enough speed and volume that the defender would be unable to reorganize their limited reserves. The Bank of England's first line of defense was to spend billions of pounds from its reserves to buy its own currency, attempting to shore up the price. That morning, they also tried to attract buyers by aggressively hiking interest rates from 10% to 12%. These traditional tools were ineffective against the massive selling pressure. By midday, it was clear that no mechanical rate adjustment could counteract the market's lack of confidence. When an asset's perceived value is completely broken, finite reserve spending cannot stop a market-wide exit. In the early afternoon, the Bank of England announced an emergency rate hike to 15%. This is a loop diagram tracking the psychological shift in the market. The emergency hike failed to project strength. Instead, it served as a signal that the central bank's defenses were nearly exhausted. Within hours, the British government capitulated, withdrew from the exchange rate system, and allowed the pound to fall. Soros's quantum fund successfully closed its position, netting a profit of approximately $1 billion. The collapse showed that even a major industrial nation cannot maintain an artificial price once the global market decides that price is no longer sustainable. By the late afternoon on September 16, 1992, the entire London financial district was practically tearing itself apart. After hours of frantic maneuvering behind closed doors, the British government finally gave up, conceding exactly what the market had already decided. The decision was total capitulation. The British pound would be withdrawn entirely from the European exchange rate mechanism and left to float freely. This chart maps the immediate mathematical destruction. Within hours, the value of the pound plummeted 15% against the German mark. Against the US dollar, the drop was even more severe, crashing down 25%. Britain had spent 2 years and billions of pounds trying to prop up their national currency. The moment they finally let go, all that effort evaporated. For George Soros, this exact devaluation was the specific outcome he'd bet on. He had built up an enormous $10 billion position, highly leveraged and carefully timed specifically against a pound's decline. To see the sheer asymmetry of this event, we can look at this split-screen comparison. On the left, we see the damage to a sovereign government. The UK Treasury suffered an estimated £3.3 billion trying to hold the line. On the right, we see the outcome for a single private fund manager. As the currency floated, Soros's position instantly converted, netting him an estimated $1 billion in personal profit in a single day. Almost overnight, the total assets of his quantum fund spiked from around $15 billion to $19 billion. And as the full effects of the trade worked their way through global markets over the next few months, that number kept climbing to nearly $22 billion. The British press, completely embarrassed by the spectacle of their central bank losing a brawl to a single hedge fund manager, quickly gave him a nickname, the man who broke the Bank of England. Months before the crisis, Soros identified a structural flaw that most other investors were ignoring. He realized that when a currency's price is kept artificially high purely by a government's verbal promise, rather than the true state of its economy, it is highly vulnerable. The Bank of England didn't lose this fight because politicians lacked the willpower to hold their ground. They lost because resolve cannot be logged as an asset on a balance sheet. Willpower is infinite, but the physical reserves required to maintain a currency peg are not. To keep the price of the pound high, the Bank of England had to buy every pound the market wanted to sell, paying for them with its own limited stash of foreign currency reserves. Once those reserves ran dry, the ability to control the price vanished. Looking at the aftermath today, the legacy of that collapse reveals a strange twist for the British economy. Economic historians now view Black Wednesday as a necessary correction for a country trapped in a position it could no longer sustain. Soros's attack brutally severed the UK from a currency peg it could never mathematically justify. Freed from the obligation of defending an inflated pound, the government finally had the flexibility to slash interest rates. Those lower rates allowed businesses to borrow and build, initiating a cycle of robust economic growth that lasted for years. The very crisis that broke the currency peg provided the flexibility the UK needed to escape a period of stagnation. It proved that when a market's set price and its underlying reality drift far enough apart, absolutely no institution is powerful enough to hold the line indefinitely.